it's good to be back. And yeah, thanks, Laura, for the introduction. So we heard from Theo, obviously. It's always good to have that 30,000-foot view from a macroeconomist, painting it down to how it affects consumers from a subject matter expert's point of view, right? So what we normally do is we also want to hear from the voice of the customer. So for the first time in Namibia, we actually did a survey in country. We surveyed about 500 people. We obviously had to eliminate some of those answers that really weren't helpful. We took it about a 95% confidence interval, and we went out of field in August this year. So this is really fresh data. Although when I was looking at Theo's presentation, I'm basically going to spend first 15 minutes validating all these facts. But that's okay, because that's what's important, right? You got the expert point of view, but then what is a man and a woman saying on the street? And that validation adds credibility to the data that we're seeing. So for today's presentation, I'm going to provide an overview of the consumer sentiment regarding the household finances. We're going to look at the household income levels, as well as how optimistic are consumers regarding the future income. Obviously, Theo painted some positive pictures. The specific call-out I'll say is that 5% GDP growth, we're operating with 0.6% in South Africa. So 5% is like a godsend for the rest of us, right? So that is optimistic. And then the next thing is we're going to look at the market perception on credit, because there's a lot of lenders in the room. So what is the optimism regarding credit in Namibia? And because we're doing the survey the first time in Namibia, we're going to compare the survey results against South Africa and Botswana, your neighbors. Because as Theo pointed out earlier in his presentation, there's a lot of regional nuances that are applicable to the southern region, right? So whatever happens in another market might also filter into the Namibian market. And then at the end, we'll evaluate consumer experiences with fraud, because generally when there's tough economic conditions and also with digitization happening in parallel, a lot of fraudsters capitulate on that event. They're already entrenched many of the digital systems because that is their job. They're there to defraud consumers. They're there to take advantage of people who are not familiar with digitization. So they're waiting in the works. My colleague Amrita, after the break, will actually go and explore even further regarding some of the fraudulent bottlenecks that happen with digitization, but she's also going to talk about solutions, because it's all very easy to highlight the problems, but then so what, right? So stick around for that. So starting with consumer financial health. Okay, so 80% of consumers surveyed in Namibia said their household incomes either stored or and decreased. And we saw the unemployment figures, although they're not really new, but Theo painted a picture of about 34% of unemployment, with youth unemployment around the high 60s. But that's not a picture unique to Namibia. If you look at the South Africa and Botswana household income levels, it's also not majority improving. Most of the consumers are saying the households are stagnant, income levels are stagnant, and some of them are obviously decreasing. And the issue with that is, even the consumers whose household income is stagnant, it's not improving or decreasing, what you're suffering from is the inflationary effect. You saw the food prices increasing. So most of your income is now going to basic needs, and the wants and those luxury large purchases, whether it's new appliances or cars, those are going to be stored. People are going to wait in the sidelines and wait for prices to come down and don't want to go and venture and buying those high value items. And then, so what are the factors affecting the household income? Well, job losses are the majority of the reasons why household income is decreasing, and that's not unique to Namibia. In South Africa, our unemployment remains at 32.9% and is consistently above the 30% range. Obviously, with the 50 million or 58 million population, that's a much bigger, severe factor for us. But in Namibia, 2.5 million, 30% unemployment, it's still a bit better in comparison to a larger country. But the issue is, okay, Namibia and Botswana, similar populations, but similar rates of job losses, which is a cause of concern for long term. But jobs are not the only issue when it comes to household income. We're seeing a new trend. So if you look at the second item, starting a new business, we're seeing that trend, particularly in South Africa, you see 20%, right? During COVID, and early 2019, that percent of people starting a new business to supplement their household income was at 7 to 6%. Now it's at 20. So that resilience from a consumer point of view, where there isn't a job in the market, forces them to go and explore into other avenues. And small, medium enterprises, I don't need to preach to you, they contribute a large portion of the economy in any sector. In fact, in Kenya, the guys are very proud about their SME sector because it contributes probably bigger than the corporate sector does. So as we are in a developing economy, we need to find alternative methods in terms of helping the consumer. Now, the issue that comes with that is we're in the traditional financial services sector. Our underwriting is based on rules set by more developed markets, right? So the pay slips, the proof of income, these are the things that we require to underwrite a loan. What happens when a consumer starts their own business and has variable income? What are the alternative data you need to start considering in terms of helping them get access to extra finances so that their small businesses start flourishing and then they can create the employment that so many other consumers are seeking? The other things are wage salary reductions, wage increases. They're not the majority of the sentiments. They're here or there, and that's the general trend, right? There's going to be people who's going to experience job cuts and salary cuts, but they still retain their jobs. There's going to be people who's going to have bonuses, and hopefully all of you have bonuses, and increases as their companies perform well. So I would rather just focus on the top two, the main reason being job losses as a deterrent, but the opportunity lies with starting new business. So what are the consumers' perception regarding their household incomes for the next 12 months? So this is now looking forward, and the consumer's perspectives overall, 73% of Namibians believe that their household income is going to improve, and that's from a generational point of view very much aligned from the working population. The younger Gen Z, millennials, and Gen Xers, who are all in the working segments, are quite optimistic regarding their income levels, right? But for those who are in, baby boomers. So for those who are entering retirement, obviously the income levels are going to start diminishing because you're no longer working. And you saw the money invested in money markets aren't yielding that much returns. So these consumers are going to be much more concerned compared to the younger generations who are still actively working. So something to look out for when you are lending, obviously, to older generations, is that their default rates are probably going to rise up, and the reason why they're borrowing is probably largely due to distress rather than actually wanting to go buy a new car, because I can't picture a 70-year-old man driving a new sports car, right? That's not happening. But that is cause of concern, and obviously when it's going to also add strain to the system when it comes to retirement and government subsidies as a result of that. But what about consumers' ability to service their debt? That's what's interesting for this crowd, obviously. So let's look at how consumers view their ability to clear at least one debt. It's a very 50-50 split in Namibia, and it's also a bit different when it comes to generations, right? Gen Zs, generally the younger generation starting their new job, obviously they're going to start taking on more debt as their lifestyles change, as they move into Windhoek, into the city. The city life is more expensive than living at home, obviously. Parents, as Theo mentioned, in the 30s. I too also only left home when I was 30, but that's because of cultural reasons, not my willingness to be independent, but that's different, right? So millennials as well, very much similar to Gen Zs. Now this picture is very different in Europe. Gen Zs, millennials are very different in Europe compared to other developing markets. I think that's a cultural aspect as well. There's a lot of people in Europe who, especially the younger generation, that have a different sentiment regarding debt, there's different sentiment regarding jobs. The gig economy, we often hear, aspires more in the European markets, in the Americas, but in the South African context or in the African context, traditional jobs still do appeal to these consumers. And then traditional financing also applies to these consumers. And then we're looking at Gen X guys who are generally higher indebted than the other two because they're much older, and generally Gen X consumers are the ones who have Gen Z children or Generation Alpha children, generally also have some inability now to pay debt because they're a bit more indebted. And hopefully as boomers, they're like to pay off their debt now because they're into retirement, not carrying that debt. Their ability to service debt is much higher. So the other younger generations, definitely depending on how their incomes improves in order to service their debt. As their income improves, they're likely to service their debt much faster. But the issue with income improvement generally is also leads to additional spending. So there's a big balance between the two. In South Africa, we find that every time income improves, the debt doesn't actually get paid more purchases happen. So there's a consumer education element in there, and financial literacy is very important. We often go on media and we stress the importance of, address your debt first before you make that new fancy purchase. I think it applies within the region as well to both Namibia and Botswana. So how do consumers intend on servicing the debt? Obviously, we saw a lot of unable to pay earlier. So from an awareness point of view, it seems that consumers in the Southern African region are aware of the fact that if I have debt, I need to service it, right? So, but if I can't service the full elements of the debt, how do I do it? Paying partial amount is the #1 preferred method. And then using money from savings is a big thing from South Africa. But Theo just reminded me that in Namibia, you don't save either, so it's a common trend. But the thing is, that is what happens, right? So when you have a higher level of indebtedness, you do delve into your savings. But the important factor here is that what you want to get from this slide is that Namibian consumers are aware of an obligation. It's not a market where you lend to them and then they're like, oh, we don't have to pay. That's a big concern. We've seen that in South American markets often, and that's obviously with the language issue as well, everything being Spanish, and the consumer education isn't as fluent in the Spanish language as it is in English, so we're seeing a lot of miscommunication in those elements. But within the South African context, within the Southern African context, generally consumers are aware that they do have an obligation and they do prioritize it. Borrowing money from friends and family, luckily I have not had any family borrow money from me, but it does happen. And the thing why people do that is because of fear. Right? So when we look at traditional banking systems, our language is quite strict. Our language is in the technical jargon. A lot of consumers don't want to pick up the phone and call the call center to explain the situation. They feel judged. And that's an element of empathy. We're starting to see call centers start changing in the South African market. And obviously, if that carries through to other markets, it's a bit easier. And that's an education element that lenders in our region is trying to drive. Regulators often criticize that they do these mystery type of engagement with lenders as a regulator, and they put themselves in a distressed consumers environment, and they phone the banks and they said, well, some of you guys are really good, some of you guys don't understand me at all, right? So borrowing from money and friends is an easier engagement for many consumers. Not the best thing, because that does have a social impact, right, when friends and family borrow money. So that's not something we want to see. We want to see consumers trust traditional institutions much more and have that engagement. But one of the avenues we're seeing South African lenders explore is empathy training within the call center environment, so that the agents are much more empathetic towards the consumer, especially during times of distress. The payment holiday shocks that came through the lockdown was a good lesson for many lenders to employ and actually test out some of these new empathy trainings that they deployed. And then refinancing, renegotiate payments. With fixed rate products, we've seen a bit of an increase in South Africa, but generally most products in the Southern African markets are adjustable rates, especially in the retail space, such as your clothing accounts and your retail revolving store cards. These type of things are generally, you don't really want to refinance them. In South Africa, home loans, it's an interesting environment at the moment where rising interest rates, yet the property market has not subsided. It's quite resilient. And that's largely due to load shedding. People just want to move away. I want to find lights, right? So there's a lot of refinancing on those elements that's happening. Consumer budget adjustment over the past quarter. So what's the first thing consumers do when they're finding distress? The only thing that you can actually do is cut back on the expenses, right? You withhold some large purchases because that's within your control as a consumer. We are in Windhoek Country Club, so don't talk to the manager about this, but 1 in 3 consumers are canceling memberships, and that's memberships for social clubs, that's memberships for elite, I would say business commitments that people are having, and these are all controllable things that consumers can do. The good thing we're not seeing is increasing consumer spending, because that's not logical to do that. But the other thing on the other side of things is for consumers who have debt, paying down debt faster is there. Again, there's that awareness in the Namibian and South African market. We asked our Botswana colleagues why the act of paying down debt faster is not a big thing in Botswana, but that's because they have a lot of payday loans. So it's not that the consumer doesn't want to pay the thing, it's the way the loans are structured. There's a payday loan, so it's automatically deducted. So consumers are not forced to go do that. The other thing is, the bottom one is quite important. It's a good thing that Namibians are saving for emergency fund. I think the lockdown has shocked a lot of people into the fact that you have to have some liquidity, right? And we saw where some of that liquidity goes when consumers struggle. They use that extra savings to go supplement some of that debt repayment. So that's a positive sign for Namibia. Doesn't exist in South Africa and Botswana for some reason. And that's a survey in South Africa is 1,200 people. They all say, no, we don't save for emergency funds. So quite a shocking thing for us. But in Namibia, there is some comfort for you guys that your people do save a little bit. So positive. So what are consumer budget adjustments over the next 12 months? They do expect bills and loans to increase, and you saw Theo presented earlier that as our country saw increased rates to protect our currency, likelihood of your interest rate rising is going to continue. The other thing that Theo pointed out was your retail sales are up, but you are net importer of goods and services, right? So cost of things are going to increase continuously until some form of cut starts happening. But the things that are also been cutting back is continue cutting back on discretionary spending. So not everybody's going to be eating out. But the problem is, when does it stop? Because there's going to be a threshold that consumers just want to cut back anymore because you don't feel like you're living anymore. And that's an important tipping point. So it'll be very interesting to see what SARB says in our country. But there is a bit of independence when we looked at the data deeper. When we looked at generational views, your younger consumers are going to continue increasing spending, right? So if you look at the yellow bars on the Gen Z column, they're still quite balanced compared to the overall. Millennials as well, their bills are expected to increase more. As millennials, the oldest millennial into the age of 40, you're likely to see some of these millennials have Generation Alpha children, right? So those bills are going to start adding up as the children gets older, school commitments, school fees, all of that starts filtering in. So your younger generation are going to still continue spending. It's just depending on what they're spending on. Generally, it's going to be based on necessities and not the luxury stuff, which, if you think about it from a lender perspective, your job is to provide liquidity to make those big, large ticket item purchases. That's not where consumers are spending. So appetite for credit, I would say, is going to be suppressed, and we'll look at appetite after this. So in summary, from a household income point of view, very stagnant in the Namibia market. Everything is generally constant. There's about 1 in 5 consumers who said the household income has improved, and that's largely to starting of a new venture or a side hustle. And then majority of the population's household are generally quite flat and decreasing due to high unemployment and also the lack of salary growth within the segment. And then most consumers we saw within the Namibia population are quite optimistic about the future. There is one thing Theo didn't mention, is that in South Africa we are heading to election year, right? So with election year, somehow there are always jobs created. We don't know how. But every election cycle, if you look at the historical data, there's always temporary jobs impacted into the economy. And what that does uplift a lot of households' income levels, even though it's temporary, but it does happen. So that's something to look out for. And because of that positive trend, it has a filtering effect. It affects the economy. It affects the currency. So hopefully, as we near the South African elections, there's going to be policy changes from those politicians, and then that may enforce certain things that improve the economy and hopefully help the rand, which then helps you because you are dependent on a lot of the South African economy, especially for basic goods like the food and wheat and those type of services. So that will bring down the average cost of basic goods for Namibian consumers, and that's something that's positive to look forward to. Servicing debt, clearly Namibian and Southern African consumers are aware of their obligations. You're seeing a lot of consumers placing the importance of at least paying a partial part of their debt, or leveraging their savings in order to make some of those additional payments. So debt is important, access to debt is important, but also repayment is quite important. In fact, your NPL ratios are significantly lower than what we see in South Africa, but your threshold is also much lower as set by the Bank of Namibia. So that's a good practice to have. South Africans, unfortunately, we do go into default quite often, and that's something that we're trying to manage through financial education and financial literacy. It's something that Namibian consumers and Namibian lenders can obviously add on as part of your training regimes for the consumers. And then consumers who are facing headwinds, obviously, as incomes improves, hopefully that alleviate some of those strains, and you're likely to start seeing large purchases increase. The issue that Theo pointed out, a lot of cash sales, Hopefully, Amrita will talk about this later. Generally, what we see in South Africa with cash sales inflating, a lot of dodgy money laundering stuff happens. And that does create some bottlenecks within the environment, right? What is that trust element is gone, right? That's questionable when that happens. And lastly, forecasting spending, obviously, because the economy is tough, consumers are likely to cut back on discretionary spending and large purchases for the next 6 months or so until something miraculous happens within the market. And yeah, look out for the South African market. I guess it's something that's going to be a good lead indicator for you to forecast what your consumers are about to do. All right, so on the topic of financial inclusion, which is very important, and the theme of our summit today was you only get real growth in the financial service sector by being more inclusive, especially in the developing market where large population isn't part of the system, right? So when we talk about growth, it's okay to talk about changes in pricing, changes in cross-selling and upselling to an existing base, but that only services so far. True growth comes from being more inclusive, getting the people who are not in the system onto the system, and that's what's important. So what are consumers' attitudes within the Southern African region regarding their levels of participation and the importance of accessing these type of systems? The first question we asked was, they believe that access to credit in lending products is fundamental to achieving the financial goals. 93% of Namibian consumers said yes. Same type of sentiment expressed in Botswana and South Africa. But the next important question is where the data actually creates a massive gap. So the next question we asked was, how many of you believe you have sufficient access to credit? 1 in 3. And that's the same trend in Botswana and Namibia. So from 90% believing that access is important, only 1 in 3 believe they have sufficient access. And then the next question, do you intend to apply for finance or refinance your existing debt because you're saying you have perceived low level of access, right? No, 1 in 3 of those consumers said only 1 in 3 of them said that we're likely to apply for new credit or refinance. So what's happening here? It's very important. I don't have access, but I'm not planning to apply for access either. So there's a big gap in terms of appetite for credit. And if for those who do intend to apply for credit, these are the 3 products that in Namibia consumers are putting priority on. Student loans, 35%, personal loans, 24%. Now, personal loans is interesting because it includes microfinancing in the definition of this personal loan. So for micro lenders in the house, that's your product is perceived as the second most important. And we saw vehicle loans, touching on what Theo touched on earlier regarding the cash and vehicle financed purchases. There is a demand for vehicle loans within the Namibian market. In South Africa, we're not seeing that at all. People are so put off in terms of buying cars, and that's largely due to the fact that even second-hand vehicle prices are increasing in double digits, 16% year over year. So the cost of those vehicles are becoming really unaffordable in South Africa. The average finance vehicle in South Africa is at 350,000 Rand, and that's with the balloon payment. So it's becoming more and more out of reach for many of the masses in South Africa. So to see vehicle loan appetite within your market, that still says the average Namibian consumer may be doing better than the average South African. Obviously, there's a big population gap, so it's not good to compare apples and apples, but from a perception point of view, it's important. So if you compare Namibia to South Africans, if you look at the products in South Africa, personal loans, credit card, and BNPL, what are those products generally used for? Personal loans, it's an installment product, but it's a cash-based product, right? Consumers take that personal loan, withdraw the cash to do what? Retail purchases, buying clothing, buying basic goods. Same thing with credit card. That open utility allows you to do a lot of retail shopping. And in South Africa, in more of the affluent areas, we're seeing BNPL becoming more popular. Interesting on BNPL, so before it becomes a big trend within your market, something to look out for is 9 out of 10 BNPL service providers across the world make losses. Right? They suffer quite bad. Klarna, the biggest one in the world, they're the only one that makes profit. And in South Africa, we do have a few. Don't think I'm allowed to name them, but you can Google. They do make profit, and the reason why they make profit is because you will never see a BNPL advert in the townships. You'll only see it in Cape Town, in Sandton, the most affluent areas. So their book in South Africa is 80% weighted towards high net worth individuals, and they don't advertise for lower LSMs. And that is also to keep the regulator away, because the regulator is allowing them to operate in a sandbox environment. But as soon as those BNPL starts defaulting heavily, that's when regulators get in play. So those providers are playing a smart game at the moment in terms of targeting more affluent consumers. But again, if you're looking at the trend of where the appetite is going, it's going towards retail spending, not large purchases. So it's an interesting trend. It hasn't come to Namibia yet, but it's something to look out for as these players start expanding into different markets. So what are the abandonment rates for those consumers who did want to take on? So now you're seeing a compounding effect, right? So just a reminder, we got the 90% of people who said, very important to achieve my financial goals, to have access to credit. Only 1 in 3 have sufficient access, and out of those people, only 1 in 3 want to apply for credit. So that diminishing compounding effect is coming into play, but even more so that you're going to see abandonments happen for those consumers who do intend on taking credit. Okay, so 61% in Namibia, right? I wanted to take a personal loan, but when I went to go apply for it, I ultimately abandoned. I don't want to go through with it. In Botswana and South Africa, it's more closer to 50-50. We actually, in South Africa, 3 months ago, in the last quarter, this figure was high as 60, but now it's gone down to about 50-50. But in Namibia, that 60% is kind of a concern, right? So what are the reasons why consumers are abandoning that? It's the cost of credit being too high, right? So when we look at boomers in particular, as their income levels go down, as they enter retirement, obviously the impact of interest rates is going to affect their decision the most. But looking at the millennials and Gen X consumers, these are consumers who are working with really good, probably jobs and higher income compared to all the other generations. Interest rate is impacting most of their decisions regarding applying for credits. Something that you can't have control over, unfortunately, because it's driven by macroeconomies. And that's the same when we ask the question regarding from a generation point of view, cost of credit is a big trend. 1 in 3 are saying cost of credit. Income status is also a popular one. But the other reasons that you should be focusing on, which is generally in the middle band, right? Taking too long to get a decision, and it's too much work to apply. So on the top of the reasons, the cost being too high, the credit history, these are things you can't control. But the things that you can control, being the process being too long, or it's too much work to apply, these are within the lender's control. These are something you can do in terms of improving your processes to make your products more accessible. These are the things you should be focusing on. There's no point in focusing on trying to lower the cost because you can't dictate that. But you can determine how fast a decision is made. And with Gen Z consumers in particular, this question wasn't asked in the Namibia survey, but it was asked in South Africa. 68% of South African Gen Z consumers said they would pick a lender who may offer a higher rated product if they got instant approval, right, through that digital process. If I went to lender A and I got an instant approval and they charged me 1% higher interest rate than lender B, which took 5 days, I'm going with lender A because they gave me the instant approval. So that instant gratification is starting to seep into the consumer preference, and how you respond to that request when the consumer applies for a loan does matter. So again, that's something that you can develop. Obviously, it's an investment that you need to make upfront, but something to consider as the younger generation comes into the pipeline of potential business for you. It's important to know that their preferences are a bit different. The older generations still prefer, I don't mind if it takes 2 to 3 days to get approval, but the Gen Z guys are saying, no, I want that instant approval because when I subscribe to Netflix, I can watch it immediately after. So, and it's a funny thing to see, because we're also seeing that in South Africa we have these on-demand services increasingly rampant within the suburb areas, right? Ordering something from a grocery store and getting things delivered in 60 minutes starts to change the perception of that consumer, saying, hey, if I can order groceries in 60 minutes, why can't I get a banking card? Why can't I get a banking service within within an immediate request, because you guys invest so much money on technology. The banks keep talking about AI and machine learning, how to improve their process through that. Why can't I get my bank card in 60 minutes? So these are the questions younger consumers are asking, and that expectation is starting to come through during their experience when they interact with you. So importance of credit, obviously in the Southern African region, very important. 90% of all consumers believe that access is important, but only 1 in 3 believe that they have sufficient access. So access, enabling access to these consumers is what we call as, improving the financial inclusiveness within our markets. So it's something for all of us, we're all responsible for, and that's something. It's not going to be achieved in a year, but it is something we all should strive for in terms of how to get true growth. Appetite for credit right now is down mainly due to the cost, but there are avenues that you can improve in terms of improving your growth rate, and that's to improve your processes during the onboarding journey, and obviously locking in that experience. Another thing from a credit data point of view, because in South Africa I do look at credit active data, and in the personal loan space, in the South African market, 93% of personal originations are repeat borrowers. So people come back to you. If they have the first experience with you being positive, they're likely to borrow from you again. So that's something that obviously is a lesson learned that we looked at, and that's a trend we looked at for 3 years. It's about 89 to 94% repeat borrowing behavior on originations. Something to keep in mind. And then appetite for credit products in Namibia are weighted towards younger consumers, because older consumers, as they hit retirement age, they like to deleverage because they don't want the financial obligations of repayment. Okay, so the other thing that's important when it comes to consumer sentiment is how they perceive their identity being asked, especially in our sector, where we have to have so much compliance, we have to keep record of consumers, we have to have proof of payments. All these things are quite important, but they are invasive from a consumer's perspective, right? You're asking a lot of personal information from me. Where is this information going? So before we get into the identity part in particular, I want to focus on the fraud attempts that happen within our markets. So we obviously surveyed all 3 countries, and the one that's important on your far right and my left is I'm not aware of any fraud schemes targeted against me. So that's a good thing, right? I'm not aware of any fraud that happens, but the bad thing is because you're not aware, you might have fallen victim already. So that's a cause of concern we generally see, because every time we present this to some of the lenders, they're like, well, it's not a big thing because people are not aware and they don't care. It's like, no, the issue is because you're not aware, these consumers are likely falling victim, and because you are not aware, there are new trends of fraud that may be emerging that you're not picking up on, right? So that not aware part, we want to see that being a low percentage as well. The second column is second structure is very important, being targeted, but do not fall victim of it. And that's important because there is awareness in the market. People are not so easily duped, and that's very important. And consumer education needs to be pushed out consistently to update consumers on what type of fraud trend that happens. So what are the fraud trend that happens? The most frequent thing that happens in the Southern African region is money and gift card scams. Why? Because they're mostly cash-based. Once that transaction happened, the scammer has your money, they're very happy, you're at a loss because you cannot get that back. Now, if you perform that transaction on a credit card, that may be a different story because you can reverse the transaction. The lender can actually pinpoint where that money is going through their partnership with Visa. So it's a bit easier when those transactions are done on credit rather than cash. But generally speaking, money and gift card scams are common because they're cash-based, and they're also an instant transaction that happens. Once you're scammed, you're scammed. The second part is phishing. So phishing, smishing, and vishing are generally the 3 that normally happen within our markets, and I've just grouped all of them together under the phishing banner. 1 in 3 consumers are experiencing that, so it's a very frequent thing. Frequency helps in terms of spreading awareness, but also it creates some level of overconfidence within the consumer as well. If you're being targeted frequently, you feel like every single call is an attempt to defraud you, but that may not be the case. So sometimes consumer becomes overconfident and then they become victim of it if there's more social engineering applied by the fraudsters. So something to look out for. Third-party seller scams, we're seeing this increasing, And this is likely to increase continuously, especially when consumers start venturing out, starting, whether it's a side hustle or alternative revenue streams, they're going to start seeping into this trap much more commonly. In Colombia, we saw this quite high. I think it was around 48% from the latest consumer polls that third-party seller scams are actually running rampant in the Latin American market. Not so much in South Africa and the Southern African regions as much. It's about 30% in Namibia, but 1 in 5, 1 in 4 in the other two markets. The other thing is identity theft is quite low on the most frequent thing, but if we're looking at the reasons why consumers are concerned about sharing of personal information, 89% of consumers in Namibia have a concern about sharing information, 94 in Botswana and 92 in South Africa. And the reason for the concern is identity theft. Now, the frequency of that fraud happening isn't that high, but why is the fear of, from a consumer's perspective, so high? It's because once it has happened to a consumer, generally they do spread this news about within the families, they do talk about this, and that fear starts spreading. But the issue is the focus then becomes only on identity theft, not on the other fraud items that happen. And the issue with that is then you become negligible with other types of fraudulent events that happen because you focus so much on just the identity theft. Now, the issue with that also is people withhold information when it's actually necessary. When they apply for traditional financing, you need that information. People are fearful of sharing it because they fear that this information is going to be taken by somebody else and it's going to be stolen and my life's going to be in ruins. But the education element is that we keep on in South Africa pushing is that no, there are tools in place that we do build and we need to instill that confidence back in consumers. So hopefully we're seeing this reason for concern actually drop as more trust is built into the system. The other issue is unsolicited marketing communications. I don't know about you, but I get like about 30 SMSs every day about some awesome deals that happen. And in South Africa, especially younger consumers, the first time they get that cell phone, the first time they start shopping, they do fall victim to those things, right? Even though those things have been in the market for a very long time, people still fall victim to them. So another reason why if someone fell victim to it once, that person in particular are unlikely to share a lot of information with even respectable institutions because they just fear that there's a bad actor within that institution that may lead to their information being leaked. So definitely something that when we engage with consumers, when we train our call center agents, something that we need to instill through that relationship and engagement with consumers. And government surveillance, not so much here, but in other markets, especially in the Asia region, it's very high. But luckily in Southern Africa, we don't have that issue. So, okay, so I talked a lot and we covered a lot of information. The one thing that TransUnion always recommends from an engagement consumer point of view, especially in developing markets where financial literacy rates are low, is promote financial literacy, right? We're seeing in South Africa, if you look at all the banking websites, the product descriptions as to what they're offering is explained in much more explicit detail, not just the cost associated with those products, but what those products are actually used for. Generally, if we looked at some of the banking website, we go into the personal loan space, they actually give examples of what personal loans are used for, what credit cards are used for, why this product could be more suitable for you than the other one. That consumer education element is being pushed at a rampant pace for many of our lenders, and that's obviously with some regulator intervention as well, but the importance, ultimate goal there was to promote more financial literacy so that consumers are aware of the products they take, but then also it carries through when it's time to service the obligation, right? So that I understood what the product is, I know I'm obligated. When the repayment comes, it's not a shock for me because I sign up for this. So that financial awareness and education needs to be continuous, but also you can engage consumers by teaching them which products is much more suitable for them so that the likelihood of them taking on a particular product is going to be much higher. I can imagine a lot of consumers who are not used to traditional financial products, when they look at all this jargon, it is intimidating. But as we spend more time simplifying the language and working on the engagement process, it does help a lot of the consumers, and you build that relationship because you took the effort to educate that consumer. They feel like there's a relationship being built there because you took the effort to explain this complex banking product that I'm not really aware of. Now I understand it. So definitely a lot of lessons learned we learned from our lenders who have implemented it in the space, and they're saying the experience has been really positive. And with that repeat borrower statement I made earlier, it comes into fruition, right? If that person took up that product with you, they're likely to take a second product with you again. So from an acquisition point of view, you can't do too much regarding the interest rate because that is set by macro variables. But what you can do is leveraging that digital onboarding experience. And unfortunately, it's not really up to you to decide which year you're going to be implementing that, because these younger consumers, as they become of age and they qualify from a legal point of view for these type of products, that's the experience they want. They want that digital experience. They don't want this cumbersome process where it takes 3 days for approval and I have to wait for an SMS to be sent back to me. No, I want my instant approval. So that's something we as an industry can work towards in terms of fulfilling that experience, making it more streamlined. Like I mentioned earlier, Amrita will talk to you about why it hasn't been streamlined yet, because there are several bottlenecks we'll work through. But it's important that something that we build towards is streamlining that experience. The next thing is identifying segments prime for prudent growth, right? We know that young consumers, as they into the workspace, as they move out of their family or parents' home, like Theo and me did, we're going to have additional spending that needs to be met, additional requirements, vehicle finance, obviously being a popular product in Namibia. What are those consumers? Who are those consumers who are likely to buying a car? Having that early segment view is very important in identifying your future consumer. And if I identify that consumer, is that consumer likely to take up my product and offering? And is that consumer likely to repay the obligation? These are the things that segmented views and deeper analysis into the consumer segment can yield. And it's something that you should focus on from an acquisition point of view. In terms of management, we normally look at early predictors and early warning signals that we normally use in terms of determining the likelihood of somebody defaulting. In Namibia, the NPL ratio is fairly low, so it's not something that you need to stress on. But as you take on these early, younger consumers who don't have the experience that older consumers have, some tools that should be built in order for you to predict likelihood of defaulting will be helpful in terms of managing your book and keeping the NPL ratio under the crisis trigger of 6% as set by the Bank of Namibia. And my time's up. Said a lot. Hopefully it's not too much information overload, but hopefully you found the information useful, because this is sentiments expressed by 500 Namibian consumers that we managed to get from the ground. So it's the voice of the people. Thank you.